Hello friends and subscribers, welcome back to Readings in Impact Investing. My name is Daniel Rosehill. This is a podcast which I set up a few days ago and a YouTube channel which is intended to bring reports in impact investing to a wider audience through the medium of audio. So I did a couple of readings already of big chunky reports from the Global Steering Group, the GSG, and the Impact Taskforce, the ITF. And I thought, as they are so laden with acronyms and particular institutions, that it might be a good idea to do a new series of videos, or to begin a series of videos talking about not just definitions but explanations of what bodies that are sort of confusing and might seem overlapping are. So I want to lump three into this video, and I'm going to be reading from three different sources. Those three institutions, which we heard a lot about in the Mobilizing Capital report, are development financial institutions, or development finance institutions. It does get a little bit confusing. Development financial institutions, DFIs, multilateral development banks, MDBs, and finally public development banks, which are PDBs. So I'm going to read for DFIs. There's a lot of resources, but I'm just actually going to read the Wikipedia because it's relatively short and concise and just explains what they are. For MDBs, I'm going to read the Investopedia piece. And for PDPs, there's a resource coming here from IFAD, the International Fund for Agricultural Development. So hopefully after hearing these side by side, it'll be clear exactly what the differences are. Development Finance Institution from Wikipedia on the date of reading, because Wikipedia, well, I guess everything on the internet is kind of a dynamic resource. So all this information is being sourced from the web. That sounds very old-fashioned. Sourced from the internet on December the 27th of 2023. So let's start with the DFI from Wikipedia. Development Financial Institution, DFI, also known as a development bank, is a financial institution that provides risk capital for economic development projects on a non-commercial basis. That's the key operator there. DFIs are often established and owned by governments or non-profit organizations to finance projects that would otherwise not be able to get the financing from commercial lenders. They are often structured as a company that provides loans for projects that a government or non-profit wants to encourage for non-commercial reasons. They can be at a local, national, or international level. DFIs include multilateral development banks, national development banks, bilateral development banks, microfinance institution, community development financial institutions, and receiving loan funds. So as such, DFI is kind of a catch-all term, including multilateral, these MDBs, and national development banks. Development banks are this is in the history section, development banks are a relatively new type of bank. Early developments included agricultural and land development banks, such as the land development banks in India, which were established in the 1920s. One of the early international development banks was the French Development Agency, established in December 1941 to finance projects in the French overseas provinces. In December 1945, the World Bank came into being, and this became the largest development bank. In February of 1948, the Commonwealth Development Corporation, or CDC, was founded in London. Mandate. DFIs can play a crucial role in financing private and public sector investment in developing countries in the form of higher risk loans, equity positions, and guarantees. DFIs often provide finance to the private sector for investments that promote development and to help companies to invest, especially in countries with various restrictions on the market. Some development banks include socially responsible investing, environmental and social governance (ESG), and impact investing criteria in their mandates. Governments often use development banks to form part of their development aid or economic development initiatives. Finally, just one note here on climate financing. As of November 2020, development banks and private finance had not reached the $100 billion per year investment of climate financing stipulated in the UN climate negotiations for 2020. So that was just a little bit about DFIs, or development banks. Now the Investopedia entry for multilateral development banks, written by Will Kenton, updated on April 25th, 2021. What is a multilateral development bank, or MDB? A multilateral development bank is an international financial institution chartered by two or more countries for the purpose of encouraging economic development in poorer nations. I'm generally going to refrain from kind of adding my own notes here, but I would say the note is that the key difference between a DFI and an MDB is in the first letter of the acronym multilateral. DFI, or development bank, is set up by one government or country. This is a very short answer to what the difference is. And the multilateral development bank is a multilateral DFI, basically. Multilateral development banks consist of member nations from developed and developing countries. MDBs provide loans and grants to member nations to fund projects that support social and economic development, such as the building of new roads or providing clean water to communities. Key takeaways. Multilateral development banks originated in the aftermath of World War II to rebuild war-ravaged nations and stabilise the global financial system. Today, MDBs fund infrastructure, energy, education, and environmental sustainability in developing countries. While commercial banks seek to make profits on loans and other financial services, the goal of MDBs is to issue grants and low-cost loans to improve the economic conditions of impoverished or developing nations. MDBs now operate throughout the world and control trillions of dollars in assets. Multilateral development banks are subject to international law. They and other international financial institutions, such as the International Monetary Fund, originated in the waning days of World War II, when the US and its allies established the Bretton Woods institutions to rebuild war-ravaged nations and stabilise the post-war international financial system. The World Bank, which has been semi-officially nominated by the US since its founding, is one of these institutions. Unlike commercial banks, MDBs do not seek to maximise profits for their stakeholders. Instead, they prioritise development goals such as ending extreme poverty and reducing economic inequality. They often lend at low or no interest or provide grants to fund projects in infrastructure, energy, educational, environmental sustainability, and other areas that promote development. Types of multilateral development banks. There are two main forms of multilateral development banks. The first, which includes the largest and best known institutions, makes loans and grants. These banks often distinguish between poorer borrowing members and wealthier non-borrowing members. Examples include the World Bank, founded in 1945, and the Inter-American Development Bank, IDB, founded in 1959. The second type of multilateral development bank is formed by governments of low-income countries that can then borrow collectively via the MDB in order to secure more favourable rates. The Caribbean Development Bank, CDB, was founded in 1969 and is an example of this type. Major multilateral development banks include the European Investment Bank, the International Bank for Reconstruction and Development, World Bank Group, Asian Development Bank, International Development Association, World Bank Group, Inter-American Development Bank, IDB, European Bank for Reconstruction and Development, African Development Bank, Asian Infrastructure Investment Bank, Islamic Development Bank, Central American Bank for Economic Integration, and the New Development Bank. Finally, public development banks. Finance in common. Public development banks, or PDBs, are a vast family of institutions at the intersection between finance and public policy. They share four characteristics. They enjoy independent legal status and financial autonomy. They are controlled or supported by central or local governments, and they execute a public mandate addressing market inconsistencies, notably for the financing of small and medium enterprises, essential infrastructures, local financial markets, housing, small agriculture, and regional and international trade, to the benefit of entrepreneurs, rural households, and the most vulnerable, including women and young people. They are not engaged in commercial banking, individual bank accounts, or consumer credit. And just one other paragraph that I think would be good to include as well here is that there are now more than 500 public development banks around the world operating at subnational, national, regional, international and multilateral levels. The volume of activity of these institutions amounts to around $2.2 trillion annually, a staggering 10% of the total amount invested in the world every year by all public and private sources combined. With their public mandates and counter-cyclical roles, public development banks are more relevant than ever to contribute to the reconciliation of economic recovery and sustainable development. These institutes represent a visible hand that can help mobilize and direct the finance we need for the future that we want. Thanks for listening to this episode of Readings in Impact Investing. I hope this was helpful to highlight some key terminology that was used in the reports that were read so far. If you have colleagues in the world of impact investing who you'd like to share this YouTube channel or podcast with, please do consider passing on the link. And if you'd like to get in contact with me for any reason whatsoever, the email address is public@danielrosehill.com. Thank you for listening today.